Hi friends, welcome to EduTap. So today we are going to discuss some important MCQs on the topic of accounting standard for depreciation and fixed asset. Now fixed asset is a very important item which you would find in the balance sheet of almost every company. Now how this value at which they are to be disclosed in the balance sheet is arrived at, how we account for depreciation. So all those aspects we are going to discuss in today's session. So let's start the discussion. First question is, which of the following accounting standard prescribes accounting treatment for property, plant and equipment PPE? So they are not those PPE kits which the doctors wear. So they are property, plant and equipment. They are same as the fixed asset. We call them fixed asset, but the accounting standard, it uses the term property, plant and equipment. So this is the international term which is used to refer to the fixed assets. Options are AS2, AS3, AS10, AS13 or none of the above. So here we have to remember that the accounting standard 10 revised, this is one which deals with accounting for the property, plant and equipment. Now earlier we also had this accounting standard 6. Earlier we had two accounting standard, one accounting standard 6, one accounting standard 10. Accounting standard 10 it was fixed asset, accounting standard 6 it was depreciation. Now this accounting standard 6 it has been discontinued and this AS10 it has been revised and it is now AS10 revised, which is property, plant and equipment. If you talk about the Ind AS equivalent, Ind AS 16 it deals with property, plant and equipment. So this is something which you should remember here. So the answer to this particular question is going to be option number C. AS10 deals with accounting treatment for property, plant and equipment. So here is the question. As per AS10, which of the following tangible items with useful life of more than 12 months would be classified as property, plant and equipment? So just carefully take a look at this word as well. It is written tangible item. Now we have to remember that there are two sorts of assets that we are having. One are tangible assets and other are intangible assets. So tangible assets, they are all those assets that we can touch. In respect of the fixed assets we are talking about here, the fixed assets can be tangible or they can be intangible. So tangible is something which we can touch, we can see, we can feel. It would be tangible. For example, I can feel my furniture, I can touch my air conditioner, I can touch my building. So these are tangible fixed assets. But again, there are some categories of assets which are intangible, like trademark, like patent, like copyright. They are intangible assets. So these intangible assets, they are not covered under the scope of AS10. We have a separate accounting standard 26 which deals with intangible assets. So now our area of scope is only going to be tangible assets. We are only going to study about the tangible fixed assets. So we have to tell which of these they are going to be classified as fixed asset. Held for use in production of goods, held for rental to others, held for administrative purpose, all of the above or none of the above. So as per AS10, property, plant and equipment, this would mean tangible items which are held for any of these three, okay, and expected to be used for more than 12 months. So the fixed assets, they are going to be definitely used for more than 12 months. If they were to be used for less than 12 months, they would be rather classified as a current asset. So these two conditions are being specified. One is with regard to the use and another one is with regard to the period. So tangible items expected to be used for more than 12 months, and what is going to be the purpose of usage? This purpose of usage is you use them in your production or supply of goods or services. For example, you bought a new machinery, you are going to produce goods out of it. Okay, you are a service provider, you bought a new furniture for your office. This is again going to be a fixed asset. You have some equipment, you have some machinery which you give to people on rent. So suppose you have gensets with you, you have generators with you, and whenever anyone has a function in his or her home, you would give that generator to him on rent so that they can use it for the night, for the day. So now this particular asset for you is going to be a fixed asset which you use to give to rent to others. Similarly, now many companies, they are giving cars on rent for some period of time. They are giving scooters on rent for some period of time. So all these kinds of items, they are expected to be used for more than 12 months and they are kept for rental purpose. So they again are going to be fixed asset. Then is administrative purpose. So administrative purpose, all the furniture that you have, you use it for administration only. Your administrative staff is sitting in an office or is sitting in a building, and this building has lots of stuff in it. It has ACs fitted in it. It has chairs, it has furniture, it has computers. Everything is in it. Everything is there in it. So all these, they are also going to be classified as fixed assets or property, plant and equipment as per AS 10. So we have to remember these two conditions. 12 months, very easy, and used for production or supply of service or rental to others or administrative purpose. So this is something you have to remember. Now we can easily answer this question that all of these, they are going to be classified as property, plant and equipment, held for use in production, held for rental, held for admin purpose. Answer is option number D. Another question, as per AS 10, cost of an item of PPE would include inauguration cost of a new facility or business, cost of advertising and promotional activities of a new product, administration and other general overhead cost, all of the above or none of the above. So we have to answer this question that what is going to be included in the cost of fixed asset. So inauguration cost of a new facility, we have bought a new machine for our new facility. Okay, we are setting up a new facility. Earlier we were manufacturing mobile phones. Now we are also going to manufacture these kinds of AC remotes as well. So we are setting up a new manufacturing facility for it. We have set up a new building. We have put in new machinery, and we are having the Muhurat function for it. We are having an inauguration party for it. Whether it is going to be included in the cost of the machinery or the new facility. And what about the cost of advertising and promotional activity? We are introducing these remotes also. So we would be promoting these, we would be issuing advertisements that we are going to be producing it. Okay, whether they are to be included in the cost of fixed asset. And again, there are going to be some admin and general overhead cost. For example, we are going to appoint admin staff to administer, to oversee, to supervise. We are going to have a chowkidar. So all those expenses, they are going to be there for this new facility, whether they are going to be included in the cost of property, plant and equipment or not. So we have to answer whether all of these or none of these will be included. So let's understand what we include in the cost of an item of property, plant and equipment. So this is what is included. One is purchase price. So at the price which you bought this new machinery for your factory, this is going to be your cost of the PPE. So this would include import duty as well. Suppose you have imported the machine from outside, and this would also include the taxes which have been paid on the machine, and these taxes, if they are not to be refunded by the government, then you should definitely include in your cost. Plus, if you have got any discounts, any rebates, you should reduce it from the price. Suppose you got the machinery from outside, the cost is rupees 10 lakh and you paid import duty of rupees 1 lakh and you paid GST of rupees 50,000 and you got a discount as well. You got a discount of rupees 50,000 as well. So how much the value is going to be for the machinery? Now, if this GST component, this is the GST component, if we would get the refund of this GST from the government, then we would not include in the cost. If suppose we would not get the refund of this GST component, then this cost of the PPE, it is going to be 11 lakh 50 minus 50, it is going to be 11 lakh. If the GST would be refundable, then this would be 10 lakh 50,000 only. So this is how we arrive at the cost of an item of PPE. It also says we would also include these items in the cost as well. So what are these items? It says any cost which are directly attributable to bringing the asset to the location and the condition. So we have got this machinery. Now we would be bringing this machinery to our factory site. We would be spending some machinery. We would be spending some amount on bringing this machinery to the factory as freight. So this freight is to be included, initial delivery and handling cost. Now we have to install this machinery. Suppose the machinery is dismantled, we have to install this machinery in the factory. So any installation or assembly cost, it is also to be included. Now if we conduct a testing of this machinery and some amount is spent in it, it would also be included in the cost. And if we hire a professional for it, if we hire an engineer that he is going to assemble the machinery or he is going to oversee the assembly of the machinery, his professional charges, they are also going to be included in the cost of machinery. So two things are there. One is purchase price and other is directly attributable costs to machinery. It can be freight cost, transportation cost, it can be professional charges, it can be installation charges. So everything is going to be included here. Now we have understood what is included in the cost of property, plant, equipment. Now let's also understand what is not included. So the cost of the item of property, plant, equipment, it excludes these things. Cost of opening a new facility or business, the inauguration cost, they have to be excluded. So suppose you have set up a new factory and you are having an inauguration party, muhurat party, something like that. So those expenses, they are not going to be included in the cost of the machinery or factory. You introduce a new product, you are advertising it, promoting it, the advertising promoting cost not to be included. You set up a factory in a new location, or you are trying to reach a new class of customers and you have to hire new staff for it. And you will also be spending some amount on training of the staff. So again, this is not to be included because this is not related to the machinery. This is rather related to the new location or the new class of customers that you are targeting. And again, the admin and general overhead cost, they would also never be included in the cost of the machinery. There would be lots and lots of cost which would be spent on admin part, supervision part, the chowkidar expenses. We are not going to include all these expenses in the cost of the machinery. So they are not to be included. Let me put a big cross here so that you remember, never include these in the cost of the fixed asset or property, plant, equipment. So now we can easily answer this one, that all of these, they are not to be included in the cost of the property, plant, equipment. So answer is option number E, none of the above. Now let's move on to the next question. Depreciation. So this is about depreciation. Options are, is decline in the book value of fixed assets, can be charged by different methods, is a non-cash expense, all of the above, or none of the above. So this question is primarily about the concept of depreciation. So if you are aware about this concept, you would be able to easily answer this one as well. So let's understand about depreciation with a very simple example. Suppose you bought a new car for yourself. Okay, you bought a new car worth rupees 10 lakhs. You got this car. You are very excited about it and you have bought this particular new car, and in totality the amount spent was rupees 10 lakh. And now the next day the order comes. Your result actually comes and now you have been selected for your favorite post and you have been posted at a different location. Suppose you were in Himachal Pradesh. Okay, you are in Himachal Pradesh and now you have been posted to Chennai. Now you have been posted to Chennai and you have to move next day only. The order says you have to come to Chennai from the next day and join the office. You bought this car, you were very happy about it, but now you have to move to your new place. You moved to Chennai the very next day and you didn't get a chance to even take the car out once to take it for a ride. You were very excited for the new job and you just moved on to the new job. Now you get involved in your new job and the time passes by. Now suppose, let's say 1 year has passed by since you bought the car. You have not been able to come to your home to try the car. You have been very busy with the new work, the new job. Now you decide to sell this car. Okay, you decide to buy a car in Chennai because you would be living in Chennai now, and you decide to sell the car in Himachal Pradesh. You bought this car for rupees 10 lakh. You have not even taken it out once for a drive. You want to sell this car. Would you be able to get rupees 10 lakh for this particular car? No, you would not be able to get rupees 10 lakh. Nobody is going to pay you rupees 10 lakh. You spend 10 lakh. The car is brand new. It has not been used even once, but still its price is going to decline. Suppose you sell this car for rupees 9 lakhs. Okay, you sell this car for rupees 9 lakhs only. This 1 lakh, the value has reduced without even using the car. So this is something which is going to be a decline in value, which is always going to be there irrespective of whether you use it or not use it. This is nothing but depreciation. Your car is depreciating every year. Its value is declining every year. So this 1 lakh is nothing but depreciation. So depreciation is decline in the value of the fixed asset. So depreciation, it can be described as a permanent, continuing and gradual shrinkage in the book value of the fixed asset. So if you talk about from the accounting perspective, every asset that you have bought is its value is going to decline. Now this decline, this depreciation is permanent. Every year the value of the asset is going to decline. This is permanent decline. It is not going to reverse. Your car's value declined to rupees 9 lakh. It is not going to come back to rupees 10 lakh. It is continuing. It is going to continue year after year. The value of the car is going to decline year after year. You sold the car at 9 lakh after 1 year. If you would have sold it after 2 or 3 years, you would have even gotten lesser amount. And this is gradual shrinkage in the value. Your car's value would decline from 10 lakh to 9 lakh, and then it would decline to say 8 lakh, 7 lakh, 6 lakh. So gradually the value is declining. It's not like the car's value declined from 10 lakh to 1 lakh in 1 year or 1 day. So this is not radical. It is not drastic. It is rather gradual decline in the value of the asset. And for the businesses as well, we purchase different sort of fixed assets. We purchase machinery, we purchase furniture, we purchased air conditioners, lots of things they are purchased by the businesses, and their value it also declines year after year. And this decline in value is shown in the profit and loss statement as depreciation. So we bought a machinery for the new business worth rupees 20 lakh, and we are going to write down the value of this machinery year after year. Suppose this machinery is going to be used for 10 years, and every year we decide to write down 2 lakh rupees in the statement of profit and loss account as a depreciation for this machinery. So every year in the statement of profit and loss, we are going to show the depreciation along with other expenses at rupees 2 lakh. Now this would also do a very interesting thing. This would also fulfill the matching principle. Okay. Now the machinery, the furniture, everything that we are using it to generate a revenue for the business. And this matching principle says you should match the expenses and the revenue. Now you were including all the other expenses, but you were not including your machinery. But now you have included rupees 2 lakh in respect of this machinery, your fixed assets as well. So this would rather fulfill your matching principle. Also the matching accounting principle also is going to be fulfilled. Your all the expenses, including expenses with regard to the usage of machinery, the depreciation, the decline in value of the machinery is also being matched with your revenue. So now your profit figure is going to be more accurate. Now the examples of depreciable assets, they would include machines, plants, furniture, building, computer, truck, van, equipment. They are all depreciable assets. But do remember that land is a non-depreciable asset. Land has unlimited useful life and therefore it is not depreciated. So this is something which you have to remember. Let's also take a look at the different methods which are available for charging of the depreciation. Now we have many methods which are there. You would find in your textbook that besides these three methods, straight line method, diminishing balance method, this is also called as the WDV, written down value method, and the units of production method, there are also other different methods which you would find in your textbook, but we are doing these three methods only as of now because they are the most important ones which are often used by the companies. Okay, so first is the straight line method. Now what this means, suppose we have got a new machinery of rupees 10 lakh. Now if we are following this straight line method, what we would be saying, okay, we would say, okay, we have got this machinery for rupees 10 lakh and we would say its useful life, it is going to be used for 10 years, and after 10 years I am going to sell this machinery. Okay, I am going to sell this machinery for 50,000. This is going to be the scrap value after 10 years. So I have to write down depreciation every year of how much? I am going to say 10 lakh minus 50,000. This 9 lakh 50,000 is going to be the decline in value over 10 years. So I am going to spread this decline over the 10 years. I am going to charge an equal amount of depreciation in all these 10 years and say 95,000 every year, 95,000 per annum. 9 lakh 50 divided by 10. 95,000 is the amount that you are charging in respect of depreciation each and every year. So this is with regard to the straight line method. A single amount is being charged to depreciation each and every year. Okay, a constant charge over the useful life of the asset is going to be there. Then is diminishing balance method. Now in this particular case, the depreciation, it reduces year after year. Okay, the value of the depreciation, it reduces. Now if we have got this machinery of 10 lakhs and we decide to write down this machinery by 10% every year. Okay, by 10% every year we have to write it down. So in the first year, 10 lakh into 10%, 1 lakh is going to be the depreciation. Okay, this is going to be the depreciation. And after 1 year, the written down value is going to be 9 lakh. And now we are going to charge 10% on this 9 lakh. So this is going to be 90,000. And now it's going to be 8 lakh 10,000. your written down value is going to be 10,000. So this is how the depreciation is charged. So this results in a decreasing charge of depreciation over the useful life. So this is how a depreciation is charged in the diminishing balance method. Then is the unit of production method. Okay, the unit of production method. You have got this machinery for 10 lakh. Okay, and this machinery is capable of say producing 1000 units. It is capable of producing 1000 units, and in the first year you produced 200 units out of it. Okay, you produced 200 units out of it. So in the first year the depreciation charge should be you have produced 20% of the units. Okay, so 10 lakh ka 20% you would charge in the depreciation, that is 2 lakh is going to be depreciation. Next year you produce 400 units out of it. So now 400 units have been produced out of total 1000. So 40% has been utilized. So 10 lakh ka 40%, 4 lakh is going to be depreciation. So this is how you charge the depreciation on the basis of the number of units that you have produced. So this is depreciation being charged on the basis of expected use or output. So they are the different popular methods of charging depreciation. So now we can easily answer this question that all the given statements, they are very true here. It is decline in the book value of the fixed asset. It can be charged by different methods. It is a non-cash expense. So depreciation every year we are writing it in our profit and loss account, and we are not paying any amount as depreciation to any third party. Okay, so this is a non-cash expense. So all of the above, they are true. And now moving on to the next question. A Limited constructs a machine for its own use. Construction is started on 1st Feb 2020 and completed on 1st November 2020, but the company does not begin using the machine until 1st March 2021. The entity should begin charging depreciation for. So depreciation का charge कब से शुरू होना चाहिए ये हमसे पूछ रहे हैं. Options are 1st Feb 2020, 1st November 2020, 1st March 2021. Either of the above depending on discretion of the accountant or none of the above. Now in this particular case, we are having three dates with us. So one is 1st of February, another is 1st of November, and other is 1st of March. So these three dates they are given to us. This is the date on which the construction is started. This is the date on which the construction is completed. The machinery is ready for use. And this is the date on which the machinery is actually used. Okay, so we have to identify from which date we would be charging depreciation in respect of this machinery. So the accounting standard is very clear in this aspect. It says that the entity should begin charging depreciation from the date the machine is ready for use. That is 1st November 2020. Okay, the fact that machine was not used for a period after it was ready to be used is not relevant when charging depreciation. After your machinery is ready to be utilized, its value is going to start declining. After your car, you got it for yourself, even if you did not use it for any period of time, the value of the car is still going to decline. So after the machinery is ready to be utilized, you should start charging depreciation from that particular point of time. So now we can easily answer this question that from 1st November 2020, the date when the machinery is completed, it is ready for use. This is the date from which the depreciation is going to be charged. So thank you friends. This was all about our today's discussion with regard to accounting standard for depreciation and fixed asset. I believe you were able to understand all the basic aspects with regard to the depreciation and property, plant and equipment. So that's it for today. Bye bye. All the best. Take care.